Welcome to the deep dive, everybody.
It's great to be here.
Today, we're going deep, deep, deep into intelligent investing. We've got Benjamin Graham's The Intelligent Investor. It's a classic.
Absolutely. A must read.
And we've got Jason Zweig's commentary to guide us along the way. Really add some extra insight. So are you ready to unlock the secrets to building wealth?
I think everyone's ready to unlock the secrets to building wealth. Let's do it.
Yeah. Steadily, sustainably, the Graham way. No risky bets, no crazy schemes, just consistent, solid growth.
It's about focusing on the long term.
Long term, exactly.
Yeah.
So before we dive into all the nitty gritty, let's define this whole intelligent investing thing. What did Graham really mean by that?
Well, for Graham, it wasn't just about picking stocks. It was a whole philosophy, a way of thinking about money and markets.
Okay.
He was all about protecting your capital, your hard-earned money, like building a shield against losses. And then from that safe position, you could start thinking about steady growth. Not getting rich quick, but building wealth over time.
Okay. So thorough analysis, protecting against loss, and aiming for adequate returns. Not necessarily those like extraordinary, shooting for the moon returns.
Exactly. You got it.
Yeah.
He wasn't chasing those flashy overnight gains.
Right,
Yeah.
right.
No, he was all about boring, consistent, reliable growth.
I like boring.
Boring is good. Boring makes money.
Boring makes money, yeah. Slow and steady wins the race.
Yeah, exactly. And one of the things that can really derail investors is this idea of market timing, trying to predict the ups and downs.
Oh, yeah. Buying low, selling high.
Yeah, easier said than done. And Graham was very clear on that.
He didn't think it was possible.
Pretty much. He believed it was nearly impossible to predict market swings with any consistency. You might get lucky once or twice.
Sure.
But over the long haul, forget about it. Even the smartest people get it wrong.
And you've got a great example of that, right? Didn't he talk about Sir Isaac Newton and the South Sea bubble?
Oh, absolutely. Sir Isaac Newton, brilliant guy, discovered gravity, laws of motion.
Big brain.
Big brain. But even he couldn't escape the allure of market mania.
Oh, wow.
Yeah. Got caught up in the South Sea bubble. This was back in the 1700s. The South Sea Company, everyone thought they were going to make a fortune, trading in the South Seas. And Newton, he bought in, saw his investment skyrocket, and then boom, bubble bursts. He loses a fortune.
So even geniuses can't outsmart the market, huh?
Nope. And that's why Graham, he focused on teaching people to identify real value.
Okay.
Not get caught up in the hype, the speculation, the fear and greed that drives these market swings.
I'm starting to see why this book is like a classic. He really wanted to help, everyday people become smarter investors.
Absolutely. Give them the tools to navigate this complex world of investing. And one of his most powerful tools is this brilliant analogy.
Okay, lay it on me.
Mr. Market.
Mr. Market. Okay, tell me more. Who is this Mr. Market?
Okay, so imagine this. Every single day, Mr. Market shows up in your door.
Okay.
He's this kind of quirky character.
Right.
And he's either eager to buy your stocks or he's desperate to sell you his.
Okay.
But the catch is he's incredibly moody.
Uh-oh.
Some days he's euphoric.
Yeah.
He's offering you sky-high prices for your stocks. Seems like everything's amazing.
Yeah.
And then other days he's a total pessimist, practically begging you to sell, at a loss.
Yeah.
Like the world is ending.
Sounds a little unpredictable. So how do we deal with this Mr. Market? How do we make sure his mood swings don't mess up our investing?
That is the key question. You got to remember, you're in control.
Right.
You don't have to let Mr. Market dictate your moves.
Okay.
You look past his daily whims and you focus on the true value of the companies you own.
All right. So focus on the fundamentals. Don't get swept up in the Mr. Market drama.
Exactly. Separate your emotions from your investments. Make rational decisions based on solid research.
Yeah.
And don't panic when Mr. Market is having a bad day.
So it's about the long game, not the daily ups and downs.
Absolutely. The long game. And speaking of the long game, Graham was a big believer in learning from history.
Okay.
Especially from past market extremes. He dedicated a whole chapter to examining a century of stock market history. The booms and busts, the bubbles, the crashes.
Because he wanted to show us what not to do.
Exactly. Learn from the mistakes of others. See how these cycles of optimism and pessimism play out.
Right.
Because there's this pattern, irrational exuberance, right? Everyone's piling into the market, prices are soaring.
Yeah.
And then inevitably the correction comes.
What goes up must come down.
Exactly.
Yeah.
And those who chase the hottest stocks at the peak,
Yeah.
they usually get burned.
Ouch. So, like the dot-com bubble in the late 90s,
Yeah.
all those internet companies with crazy
The
valuations.
poster child for irrational exuberance.
Yeah.
So many companies going public, promising the world,
Yeah.
but the fundamentals weren't there. And when the bubble burst, a lot of people lost a lot of money.
Yeah.
And Graham, he analyzed some fascinating cases, like AAA Enterprises, a company built on pure hype. Franchising, I think it was. Stock price went through the roof,
Yeah, I've heard of them.
and then poof, imploded. Left investors with nothing. A classic case of speculation gone wrong.
A good reminder that chasing hype rarely ends well. Didn't he also talk about the Penn Central Railroad, a company that seemed like a safe bet, paid dividends for years, and then suddenly went bankrupt?
Oh, yeah, the Penn Central case. That's a classic example of how even seemingly stable companies can fall victim to poor management and reckless financial decisions. Got to look beyond the surface.
Just deeper.
Exactly. And he showed how a careful analysis of the company's financial statements, looking at the balance sheet, the income statement, the cash flow statement, could have revealed warning signs long before the collapse.
So he was like always on the lookout for red flags, right? Those subtle clues that something wasn't quite right.
Absolutely. He was a master at spotting those red flags.
And didn't he also talk about what was it, Ling Temco Vought LTV, another cautionary tale about like excessive debt and unchecked corporate ambition.
Oh, LTV. Yeah, a classic case of a conglomerate that grew too fast, took on too much debt, and ultimately imploded. It's a reminder that even charismatic CEOs with bold visions can make disastrous decisions, especially when they prioritize growth at all costs.
So it's a warning against getting seduced by the hype and not paying attention to the financial realities.
Exactly. Graham used LTV as a warning sign. Be careful of companies that are overly focused on expansion and don't prioritize sound financial management.
This is all incredibly insightful.
Yeah.
We're just getting started.
Yeah, we're just scratching the surface. There's so much more to unpack.
There is. So stay tuned, everyone. When we come back, we'll delve even deeper into Graham's recommendations for building a portfolio that aligns with your risk tolerance and your financial goals. We'll talk about defensive investors, enterprising investors, and everything in between.
Welcome back, everybody.
All right, so let's shift gears a little bit and talk about how we can actually put Graham's wisdom into practice.
Well, yeah, let's
when we're building a portfolio that meets our needs.
Absolutely.
Right.
And Graham, he talked about different types of investors.
Right.
So let's start with the, what he called the defensive investor.
Okay, the defensive investor. So who are we talking about here?
So this is somebody who really prioritizes stability.
Okay.
Peace of mind.
Mm-hmm.
They're not looking to, hit those home runs.
Right.
They want to protect their capital. They want to see it grow steadily over time.
So they're not the ones like, checking their stocks every day and, stressing about every little fluctuation.
No, they understand that slow and steady wins the race.
Right.
And Graham, he recommended that these investors, they aim for a balanced portfolio.
Okay.
With a mix of stocks and bonds.
Right.
He suggested, allocating between 25% and 75% to stocks.
Okay.
And then the remainder in bonds.
Interesting. So even for the most cautious investors, he still saw a place for stocks.
He did, yeah.
In the portfolio.
He recognized that stocks, they have the potential to, outperform bonds over the long term. They can help you stay ahead of inflation.
Right.
But he also stressed diversification.
Okay, diversification. We hear that word a lot in the investing world. What does it really mean when we're talking about, putting together a portfolio?
It's about not putting all your eggs in one basket.
Right.
Spread your investments across different industries, different companies.
Right.
Because, if one company or one sector takes a hit, you don't want your whole portfolio to go down with it.
Right. It's all about managing that risk.
Exactly. Managing risk.
Okay, so what kind of stocks did Graham recommend for the defensive investor?
So he leaned towards large, well-established companies,
Mm-hmm.
Companies with a history of consistent earnings,
Okay.
a track record of paying dividends.
Okay.
Think of those blue chip companies that have been around for decades.
Right. The ones you see in the Dow Jones Industrial Average.
Exactly. Yeah. The ones that have weathered the storms.
Right.
They might not be the most exciting,
Right.
but they provide that sense of stability and reliability
Mm-hmm.
that defensive investors are looking for.
They've stood the test of time.
They have.
Yeah.
He also highlighted, public utilities
Oh, okay.
as a potential option. You know, these companies often operate in regulated environments.
Right.
They provide essential services like electricity, gas.
Yeah. Essential services, so people need those no matter what the stock market is doing.
Exactly. And that makes their earnings more predictable.
Right.
So
Right.
there's a certain level of stability there.
Okay, now what about bonds? What role did they play in the defensive investors' portfolio?
So Graham, he saw bonds as a key element for providing that stability,
Okay.
generating a steady stream of income.
Mm-hmm.
He favored high-quality bonds,
Okay.
like U.S. government bonds or highly rated corporate
Right, the
bonds.
ones that are considered the safest, right.
Exactly, the ones that carry less risk of default.
Okay.
You know, so the issuer is very likely to pay back the principal and interest
Right.
as promised.
Okay.
He also suggested, diversifying across different bond maturities.
Bond maturities. Can you explain that?
Sure. So a bond's maturity date is the date when the principal amount is repaid to the bondholder.
Okay.
So by investing in a mix of short-term, intermediate-term, and long-term bonds, you can spread out the risk
Okay.
that's associated with changes in interest rates.
Got it. So even within your bonds, diversification is still important.
Absolutely.
Spread that risk.
Spread it out.
Okay. And remember we talked about dollar cost averaging? Yeah.
Before,
Yeah.
as a way to kind of, smooth out those market ups and downs.
Absolutely.
So just to recap, that's where you're investing a fixed amount of
Yeah.
money
Right.
at regular intervals,
Mm-hmm.
regardless of whether the market's up or down.
Exactly.
Right.
Yeah, it takes the emotion out of it.
Yeah,
Helps you avoid trying to time the market.
right. So instead of trying to guess when to buy or sell, you're just consistently putting that money in,
Consistently, yeah.
bit by bit, over time.
Exactly. And over the long run, that can lead to some solid returns.
Okay, so this all makes sense for the defensive investor, but what about those who are a little bit more, adventurous?
Right.
The ones who are willing to maybe take on a little bit more risk to
Yeah.
potentially
Yeah.
earn some higher returns.
Yeah, Graham called those the enterprising investors.
Okay, the enterprising investors, so what sets them apart from the defensive investors?
So these are the folks who are willing to roll up their sleeves,
Okay.
do a little more research.
Dig deep into a company's financials
Okay.
and really hunt for those undervalued opportunities.
Okay.
So they're comfortable with a bit more risk,
Right.
and they're willing to put in the time and the effort to find those hidden gems that the market might be overlooking.
So they're like financial detectives, right? Searching for clues
I like that. Yeah, financial detectives.
that others might miss.
Yeah, they're looking for those situations where a company's stock price doesn't reflect its true worth.
And that brings us back to Graham's concept of intrinsic value.
It does.
Right, that's what we talked about earlier.
Exactly. They're trying to determine, what is this company really worth
Right.
based on its, financial statements, its business model, its future prospects.
So it's about looking beyond the hype,
Yeah.
looking beyond the headlines,
Absolutely.
and really understanding what's driving the business.
Exactly. What makes this business tick? And once they've figured that out, once they've determined that intrinsic value, they look for opportunities to buy the stock at a price significantly below that value.
Ah.
That's where the margin of safety comes in.
Okay.
It gives them a cushion
Right.
to protect against potential losses.
So even though they're taking on more risk, they're still, really prioritizing risk management.
Absolutely, yeah.
Yeah.
The margin of safety is crucial for any investor,
Right.
but especially important for those who are venturing into, more speculative territory.
Okay, so I'm curious to know more about the specific strategies that Graham recommended for
Yeah.
these enterprising investors.
Sure.
What kind of companies were they, on the lookout for?
Well, he laid out a set of criteria
Okay.
for identifying potentially undervalued stocks.
All right.
So he suggested looking for companies with a strong financial position,
Okay.
consistent earnings,
Mm-hmm.
a history of paying dividends.
All right. Sounds familiar.
Yeah, some of those same things.
Yeah.
But he also emphasized the importance of strong management teams,
Okay.
people with a track record of creating shareholder value.
So it's not just about crunching numbers, it's also about assessing the quality of, the people running the show.
Absolutely, yeah. He believed that great management could make all the difference.
Mm-hmm. And he also talked about looking for companies that were, out of favor with the market?
Yeah, the ones that maybe have been overlooked
Right.
or undervalued.
Yeah.
He believed that those often presented the best opportunities.
Interesting.
So he suggested looking for companies that were, maybe temporarily facing headwinds,
Mm-hmm.
perhaps due to an industry downturn
Right.
or a company-specific setback,
Okay.
but had the potential to recover and thrive.
So it's about finding those diamonds in the rough, right? The
Yeah.
companies that have, those solid fundamentals,
Yeah,
but the market's just not paying attention
exactly.
because they're, too focused on the short-term
Right,
noise.
the short-term ups and downs.
Mm-hmm.
Yeah, it requires a bit of patience,
Yeah.
willingness to go against the crowd.
Mm-hmm. Buck the trend.
Yeah, buck the trend. But it can be rewarding.
Now, I understand that Graham, he also had some, specific insights into different types of investments,
Yeah.
not just stocks, but also, bonds,
Right.
preferred stocks,
Huh.
convertibles.
Hmm.
Um, did he have any, specific recommendations for the enterprising investor in those areas?
He did. So let's start with bonds.
Okay.
We talked about how he favored those high-quality bonds for the defensive investor,
Right, right.
but he recognized that enterprising investors might be drawn to, more complex bond investments
Okay.
that offered the potential for higher returns.
So higher risk, higher potential reward.
Exactly. Yeah.
What kind of bonds are we talking about here?
So one type he discussed was income bonds.
Okay, income bonds. So what are those?
So these are a little different from traditional bonds.
Okay.
They only pay interest if the company generates enough profit.
So it's a little bit more like,
Yeah.
tied to the performance of the company.
Exactly.
Okay, interesting. So income bonds, got it. What about preferred stocks?
So Graham, he was a bit less enthusiastic about preferred stocks.
Oh,
He saw them as a bit of a hybrid,
okay.
offering features of both bonds and common stocks.
Okay.
So they typically pay a fixed dividend, like a bond,
Mm-hmm.
but their prices can fluctuate like a stock.
So a little bit of both.
Probably to both, yeah.
Okay.
And he felt that, in most cases,
Right.
investors were better off just choosing either a bond or a common stock.
Right. Depending on their needs.
Exactly, yeah, depending on their risk tolerance and their income needs.
Interesting. So preferred stocks, not necessarily off limits, but, proceed with caution.
Proceed with caution, yeah.
Okay. What about convertible securities?
Oh, convertibles. So these are, securities that can be converted into common stock
Right.
under certain conditions.
Right.
And Graham, he saw these as a way for enterprising investors to potentially get the best of both worlds.
Okay, I like that.
Yeah.
Best of both worlds.
So the income stream of a bond and the upside potential of a stock.
Sounds appealing, but I imagine they're pretty complex
Well, you can be, yeah.
to, figure out.
You need to understand both the bond market and the stock market
Right.
to really assess their value.
Oh, okay.
So he suggested focusing on convertibles with, what's called a reasonable conversion premium.
Okay.
So that means the price you pay for the convertible shouldn't be significantly higher than the value of the underlying common stock.
Okay. So again, it's all about finding those, sweet spots
Yeah.
where the potential rewards outweigh the risks.
Exactly.
Now, what about mutual funds? Were those a part of Graham's playbook?
So Graham, he had some interesting thoughts on mutual funds.
Okay.
He recognized that they offered diversification, professional management,
Right.
which could be appealing to a lot of investors
Yeah.
who don't have the time or the expertise to manage their own portfolios.
Mm-hmm.
But he also cautioned against blindly trusting mutual funds.
Oh, why is that?
Well, he was wary of the high fees that a lot of funds charged,
Okay.
and he felt that some fund managers engaged in excessive trading, which could eat into investor returns.
So again, it's about doing your homework, right?
Absolutely.
Before you just jump into a mutual fund.
Don't just hand over your money and hope for the best.
Right, right.
You got to understand, what is the fund's expense ratio? What's their investment strategy? What's their long-term performance track record?
So be an informed investor.
Do an informed investor, yeah.
Don't just, take everything at face value.
That's right.
Even if you're working with a financial advisor or, investing in a mutual fund, you should still understand those fundamentals.
Yeah, understand the basics.
And make sure the strategies align with, your goals.
Right.
And your risk tolerance.
Exactly.
This is all making a lot of sense.
Good.
Now I'm curious, what did he have to say about closed-end funds? Those are the ones that trade on stock exchanges, right?
That's right. Yeah, they trade just like individual stocks.
Right.
And Graham, he found those to be really intriguing.
Why is that?
Well, unlike open-end funds,
Mm-hmm.
which issue and redeem shares based on their net asset value,
Right.
closed-end funds, they have a fixed number of shares outstanding.
Okay.
So that means their price can deviate from their net asset value.
Mm-hmm.
And that creates some opportunities.
Opportunities for what?
Well, sometimes a closed-end fund will trade at a discount to its net asset value.
Mm-hmm.
So that means you could potentially buy a basket of assets for less than they're actually worth.
So it's like finding a dollar bill for 80 cents.
That's the idea. Yeah.
I like that.
Yeah, Graham believed that skilled investors could identify these discounts and profit from them.
So he was always looking for those little inefficiencies
He was always looking for those inefficiencies.
in the market.
Absolutely, yeah.
I love that.
Yeah, he was a master at it.
This has been an incredible, exploration of Graham's strategies
Yeah?
for both the defensive and the enterprising investor.
Yeah. We've covered a lot of ground,
Well, yeah.
from building a balanced portfolio
Right.
to understanding all these different investment vehicles.
So before we move on, is there anything else that we should keep in mind as we're, thinking about applying these principles?
Yeah, I think one key point to remember is that Graham, he was a strong advocate for shareholder engagement.
Okay, what does that mean?
So he believed that investors, they shouldn't just sit back and passively collect dividends.
Right.
He wanted them to be active participants in the companies that they owned.
So more than just buying and selling stocks, it's about like owning a piece of a business
Yeah.
and being involved.
Being involved, yeah. He wanted shareholders to hold management accountable.
Mm-hmm.
Attend those shareholder meetings, ask the tough questions,
Mm-hmm.
make sure management is acting in the best interests of the company and its owners.
So it's about using your voice as a shareholder
Exactly.
to make sure things are,
Yeah.
running smoothly.
Running smoothly and ethically.
Mm-hmm. And Graham, he also had some interesting thoughts on how companies should distribute profits to shareholders.
He did.
So this is about dividends, right?
Dividends, yeah.
Okay.
So he believed that companies should prioritize investing in their businesses,
Mm-hmm.
using profits to fuel growth and innovation.
Okay.
But he also recognized that dividends could be a valuable way to reward shareholders
Right.
and provide a steady stream of income.
Mm-hmm.
So he advocated for a balanced approach
Mm-hmm.
where companies would distribute a portion of the profits as dividends,
Okay.
but retain the rest to fund that future growth.
So it's all about finding that sweet spot.
The sweet spot
Okay.
between rewarding shareholders today
Mm-hmm.
and investing for a brighter tomorrow.
Yeah, I like that. The sweet spot.
The sweet spot.
So we've really taken a journey through
We have.
Graham's world.
Yeah, it's been a fun journey.
It has. It has.
A lot to think about.
A lot to think about. And it's amazing how, even though he wrote this book decades ago,
Mm-hmm.
so many of his ideas still apply today.
They do, absolutely.
We've explored his, his principles for
Yeah.
both the defensive and the enterprising investor.
Well,
And we've seen how those can help us build portfolio
right.
that meets our needs.
Yeah.
So when we come back,
Yes.
we're going to wrap up our deep dive
Sounds good.
and talk about how Graham's ideas have really stood the test of time
Absolutely.
and how they can help us navigate the complexities of today's markets.
Looking forward to it. We've been spending time with Benjamin Graham,
Yeah, the OG of value investing.
the OG, the godfather of
Yes.
intelligent investing, and it's amazing to me how relevant his ideas are even today.
In this crazy world we live in. But, the market has changed so much since he published the
Well, absolutely.
The Intelligent Investor back in the day.
Yeah, it's a different world.
So how do we take those principles, his principles, and apply them in the 21st century?
That's the million-dollar question, right?
Yeah.
And I would say that Graham's core principles, those are more important now than ever.
Okay.
I mean, think about it. We're bombarded with information.
Yeah.
Instant gratification is everywhere.
Mm-hmm.
There's always some hot new investment tip popping up. It's easy to get swept up in the hype.
Right.
Forget about those fundamentals.
It's like we're constantly being tempted by those get-rich-quick schemes,
Oh yeah.
and the promises of overnight fortunes.
Yeah, and that's where Graham's wisdom, I think, really shines.
Okay.
He reminds us that, true investing, this is about owning a piece of a business,
Right.
understanding its value, and patiently waiting for that value to be realized.
He was all about that long game.
Long game, absolutely. No chasing fads.
Right.
No trying to outsmart the market.
Right.
Just sticking to those principles.
And one of his most important principles, right, that margin of safety,
Oh, yeah.
that seems like it's even more important now.
I think it's arguably even more important today
Okay.
because we're living in a world of, volatile markets. Algorithms can trigger these flash crashes.
Hmm.
News cycles change. Investor sentiment in an instant.
Right.
So that margin of safety, that cushion between what you pay and what you believe it's worth, that's your protection
Hmm.
against the unknown.
Okay. Okay. So, we have so much information these days,
We do.
right? Real-time stock quotes,
Yeah.
financial news feeds, all these online research tools.
Tons of
Does
data.
that make Graham's approach to analyzing companies obsolete?
No, I wouldn't say that at all.
Okay.
In fact, I would argue it makes it even more relevant
Okay.
because it's easy to get overwhelmed by all this data, right?
Right.
We're drowning in information, but are you
Mhm.
actually gaining knowledge?
So Graham's teaching us to cut through the noise
Cut through the noise.
and focus on
Yeah.
what matters.
The things that really drive value.
So it's about being selective
So
with the information we consume
absolutely.
and focusing on those
With
signals
tables that matter.
and
Yeah.
that's where his emphasis on understanding financial statements,
Mhm.
right? The balance sheet,
Yeah.
the earnings, that stuff's still relevant today.
Oh, absolutely, yeah. These tools, they help us filter out the noise
Okay.
and identify those companies with a solid foundation
Mhm.
and a real path to sustainable growth.
So the sources of information may have changed,
Right.
but the fundamental principles
Yeah,
haven't.
they haven't changed.
Okay. Okay, that makes sense. And diversification.
Mm-hmm.
That's got to be even more important now.
Diversification is, I think, more important than ever
Okay.
because we have access to, such a wider range of investments today.
Right,
I mean,
right.
emerging markets, cryptocurrencies, real estate investment trusts.
It's a global market now.
It's a global market.
Right. So many opportunities, but so many risks.
So many risks, yeah. And that's why diversification is crucial.
Okay.
Spread your risk across different asset classes, different industries, different geographies.
Right.
Helps protect you from the inevitable ups and downs of any one particular market or sector.
Don't put all your eggs in one basket, right?
Right.
But on a global scale.
Exactly, yeah.
Now, remember how Graham, he talked a lot about investor psychology.
Oh, he was brilliant on that.
He was. He really believed that our emotions could be our worst enemy when it comes to investing.
It can be, yeah.
Right? That fear and greed can drive us to make, irrational decisions.
Absolutely. Lead to costly mistakes. Yeah.
And those emotions, I feel like they're even more amplified.
Oh, for sure.
Today, right?
Yeah.
We're constantly bombarded with all this,
Yeah.
news and opinions.
The 24-hour news cycle.
Right, and often with a sense of, urgency and fear.
Yeah.
It's easy to get caught up
Easy to get caught up in that.
in that roller coaster.
Oh, yeah, the emotional roller coaster. And Graham's advice
Mm-hmm.
to be aware of our biases.
Right.
Develop strategies for managing our emotions. That's so crucial today.
So we need to take a deep breath, step back from the noise.
Yeah, take a step back.
And really make sure that we're thinking clearly,
Yeah.
making those decisions based on logic.
Rational decision making.
And not just reacting to the latest headline or,
Yeah.
the latest tweet.
The latest tweet, the latest hot stock tip.
Right.
Yeah.
Got to be careful.
And Graham, he also talked about seeking guidance from professional advisors.
Yeah. He recognized that financial advisors could play a valuable role.
Helping investors navigate
Mm-hmm.
the complexities of the market, but he also cautioned against blindly following advice.
Oh, okay. So what was his take on that?
Well, he emphasized the importance of understanding the advisor's rationale.
Okay.
Understanding any potential conflicts of interest.
Right.
Asking the right questions, understanding the fees involved,
Mhm.
and making sure that the advisor's recommendations, that they align with your goals
Right.
and your risk tolerance.
So it's about being an informed consumer of financial advice.
Absolutely.
Right. Asking the right questions.
Ask the right questions.
Doing your research.
Do your research.
Making sure everything aligns with your needs.
Exactly. Take ownership of your financial future.
Yeah. And it's empowering, right?
It is empowering, yeah.
To take control
Absolutely. Yeah.
of your finances and to really understand
Yeah.
what's going on.
And that's the essence of Graham's legacy, I think. He wanted to empower everyday people to become intelligent investors,
Right?
to build wealth steadily, sustainably,
Right.
and to avoid those pitfalls that can derail their financial dreams.
He really left us with an incredible roadmap.
He did a roadmap for navigating this world.
Right, for navigating this
That's
world.
investing, yeah.
This has been such an insightful
Yeah.
deep dive into Benjamin Graham's world.
A lot to think about.
A lot to think about. We've explored his principles. We've seen how they can help us make sense of today's market and really hopefully gain some valuable insights.
Yeah, yeah.
To empower us all to become more intelligent investors.
That's the goal.
So, as we wrap up this episode,
Yeah.
the key takeaway, I think, is to keep learning, stay informed,
Yeah.
and always approach the market
Mm.
with a healthy dose of
Skepticism.
skepticism and a
Yeah.
commitment to
Yeah.
intelligent
Yeah.
decision making.
Intelligent decision making, that's what it's all about.
So we want to hear from you, the listeners. If you could have dinner with Benjamin Graham today, what one question would you ask him about investing in the 21st century? Share your thoughts in the comments below. Until next time, happy investing.